All right, hello everyone, and welcome to the Big Bang Workshop on defining your business model. And we've got Joe D'Annunzio, our Executive Director of the Institute, with us today. And it's all you, Joe. Go right ahead.
Great, thanks, Nikki. So I'll share my screen in a moment. I just want to welcome everyone. And as I mentioned before we started recording, I'm going to go through at a pretty high level some of the things we think are particularly important as you prepare your early business plan for a competition in the Big Bang. But this material is relevant to anyone, whether or not you're competing in the Big Bang. So focus primarily on business model, but given past years, questions always come up about funding and fundraising. That's not really the focus of the Big Bang per se, but it's enough of an interest that we'll spend a few minutes talking about that as well. And as I mentioned, right in the middle, 2/3 of the way through, we will stop, ask you a few poll everywhere questions, and have a bit of a conversation. As we're going, if you've got questions, feel free to interrupt or drop them in chat, and periodically I will ask Nikki to share any questions that are in chat. All right, so I am going to share my screen. And away we go. So our real focus is on building a sustainable enterprise. And we know from our work with many faculty, postdocs, PhDs, undergrads, community members, a lot of you are driven by mission, right? You see a social opportunity to make the world a better place, or something that is not optimized, in our government or wherever it might be, and that's fantastic. And others of you are thinking about building a more traditional commercial enterprise. Either way, you've got to build something that is economically sustainable. I mean, the simplest way of defining economically sustainable is you bring in more resources than you expend to deliver your service, your product, right? So whether you're trying to build something, to build a very profitable business, or you're really driven by mission, either way, to build a sustainable business, you've got to figure out your business model. Okay. So first, and as always, want to express our gratitude to our sponsors of the Big Bang. These folks are what make possible all of the events around the Big Bang, as well as the grants for the 6 pillars, as well as the $25,000 first place prize. And then you can scan the QR code on the right of this presentation to get to our link tree. Strongly encourage you to sign up for our messaging. In addition to the things that we talk about, we share relevant innovation and entrepreneurship activities on campus, whether it's the Student Startup Center or Venture Catalyst or Tech Transfer. And then there's 3 things specifically I want to call out here. First is you'll get another hour with me on April 9th for delivering your pitch like a pro. We will go through each and every slide of the 10 to 12 slide pitch deck. See what I did there, Nikki? And that's once the Big Bang is off and running. As a reminder, those of you interested in the Big Bang, the deadline is March 3rd at 1 p.m. Pacific. Urge you, sometimes there's crazy stuff. Don't wait until the last minute. There's no reason not to do it the day before or the day before that or whatever it might be. Okay, and then finally, you may know that our flagship academy we do in the fall, in September. It's 4 full days. I know several of you on this have been through it before. It's fantastic. We got a request last year from many people to do an abbreviated version of that for folks that are not able to, complete 4 days, and that's totally fine. The Half Day Academy is on campus and in the student center, and right by the silo, and we run from 8 a.m. to 2 p.m. And if you're interested, the deadline is next week, Nikki. Is that right? Next Monday?
Yes, the 9th.
Right. So if you'd like to sign up, we still have space, not a lot, but there's still a little bit of space. If you go to the link tree, that'll give you the button that you can press, and you can sign up for UCA Foundations. And I believe in addition to spending the morning and early afternoon with me, you get a dose of Andy Hargadon, and you get a lovely breakfast and lunch. Who's catering lunch this year, Nikki?
Great question because I didn't do the ordering this year, so we'll find out.
Who knows? But it's going to be good.
It's going to be great though.
Plus, you'll have me. Who needs lunch? All right. So now we're going to move on to our presentation now that we've got our messaging done. So our learning objectives is to help you think about defining and articulating your vision, what's in your mind for what you're trying to build in terms of its business attributes, right? And as you think about this, your goal is to develop a plan to validate that by recognizing and resolving the biggest uncertainties associated with the business, right? And then we're going to talk a little bit and just a little dose. This is not our focus on understanding fundraising needs and approach. And then, as always, we want to give you a call to action, right? So we're going to talk about some specific next steps to move forward. Those of you that have been in any of our workshops or programs know this is our favorite Venn diagram, right? You're thinking about market. Is it desirable, right? Are there customers? Do they want your product? Are they willing to pay for it, right? Technology, is it feasible? Can you deliver it? And remember, technology is about methodology. It's not necessarily a high-tech thing, right? Are you able to deliver your product or service, and can you scale it to the appropriate level? And then finally, what we're focusing on today, right? Business, is it viable? Is it economically sustainable, right? And so your venture needs to sit in the nexus point of these three areas of validation. Okay. So there's a very simple framework for us to start with, right? And that you have a hypothesis and a set of key questions, right? So your hypothesis, simply put, is the way you're thinking about business, it's achievable, you can do it, it's going to be profitable. And again, remember, profit, you may be a nonprofit. Profitable just means bringing in more than you have to expend, right? And scalable. And I want to pause on scalable for a moment. Some of you want to build something that can scale and reach a very large audience, and your value proposition is about helping individuals, but helping with a movement or a much broader population, and that's fine. And others, you may be thinking about something that is smaller, right? Scalable is really about, can you build it to the level that you want? One thing to note, though, and we're going to talk about venture financing in a moment, generally, if you're looking at investors, right, scalability is going to be important to them, right? Because they're thinking about, how does a little bit of my money early on turn into a lot of money when you're successful? And that's typically driven by scale. So all this is really focused on viability, right? So your challenge is to validate it first for yourself. You get rid of your uncertainty or mitigate your uncertainty, right? And then for others, co-founders, employees, potential strategic partners, potential, and of course, ultimately your customers. So some very simple questions you need to be able to answer, right? How will you make money? How much will you make? How much will it cost? Meaning, how much do you have to invest before you start being able to generate revenue, right? And when will it happen? And I'll give you an extreme case, right? You could code an app today and put it through the App Store and theoretically start generating money tomorrow. Obviously, much more complicated typically than that. The opposite extreme is you've got an idea for a drug, a small molecule, and it's going to take you a decade or more to go through the proving, the multiple phase trials, the regulatory things before you get out. So when will it happen is really important. Okay. So a lot on this slide. I'm going to cover this in a very high level, right? So you think about how will you make money. There's only a limited number of revenue models, right? And you can argue there's hybrid versions of these. You can be, a dessert and a dessert topping and a floor wax, for those of you that were alive in the 80s. But reality, it's unit sales, right? You're selling a product one at a time, right? Advertising fees, right? So something where you've got a platform where you can monetize eyeballs, right? Franchise fees, think McDonald's, for example, right? Utility fees where you're selling it on a per use basis. A good example would be our friends at PG&E, right? Subscription fees where you're charging a fixed price for access to your goods or services. Netflix, a great example. Transaction fees, right? Every time there's something associated with that, you extract a portion of revenue, whether it's Stripe or Visa or wherever else you might think about. And then finally, and I know most of you are familiar with this, license fees, right? Where you have some intellectual property, whether it's tangible or not, that you license to someone and you get paid either on a fixed basis or on a per use basis. And then the how much you will make, right, is generally pretty simple math. And I know I'm oversimplifying some ways things, but it's important to start early on, not to get wrapped up in the complexities of your business. You want to appreciate them, right? But not to get um, flummoxed by them, right? So unit sales is, what are you charging for the unit? How many are you selling, right? Advertising fees, online is typically per view or per click or per action, right? Mobile similarly, right? Franchise fees, how many franchise, percent of sales, et cetera. You can read these, right? So the second part of the math is generally pretty simple. Of course, it's going to be driven by your assumptions, but being transparent about that, right? And again, starting with something simple that you can iterate is really, really important. And then finally, in the last piece of this, how much will it cost, right? Everything you're working on is going to have some development costs. The cost it takes to create the first article, to create the intellectual property, right? To build the service out, right? If you're selling on a unit basis, you have COGS, right? COGS, cost of goods, sold, right? You're going to have a cost for every widget you're selling, right? For things like utilities and subscriptions, typically you would as well. And then everybody's going to have some level of cost of operations. If you're running a big utility business, a power company, right? You got a lot of costs and operations. If you're licensing a patent that you developed in your lab, right? Cost of operations is probably pretty modest, right? But having some understanding of these elements and how they factor into your business model, each of them is really important. Okay, so I know that's very high level, but trust me when I say we see so many early stage plans that haven't even sort of accounted for these three things of how is money going to come in, right? How much is it going to cost, right? To deliver, and when will you do it? So how do you estimate revenue and costs? So we're a big fan, as you know, of the 550, 500, right? Develop an initial vision of what you think your business model looks like. How you're going to get revenue, what are the core costs, and how are those going to evolve, right? And build it simple enough that you can collaborate with someone who's got a finance background, who understands the industry, with your co-founder, right? The simpler and more scaffold driven it is early on, the easier it is to iterate and adjust. If you invest a lot in a complex model early on, number one, you're building assumptions on top of assumptions. But number two, we all get kind of psychologically attached to the things we create. I like to call it sort of a Frankenstein business model where we put so much effort and energy into it. We have a hard time collaborating and iterating and letting go of some of our assumptions because we've built an assumption on top of assumption on top of assumption, and we are literally emotionally invested in it, right? And the second piece of this is you use a 3x5 model, and I'm going to talk about this in a little more detail in a moment. And we like to think of it as, what are the three most important drivers of revenue and expenses? So if I said you can only think about three things that are going to impact your ability and the amount that you're generating in revenue, and only three things impact the amount of and the level of expenses, what are those? And then how are they likely to change over 5 years? And again, people say, I don't know how things are going to change next week. Absolutely. When you're in early stage, it is definitely the case, right? This is more about philosophically beginning to understand what the framework looks like for your business to be able to start doing this. Think, what's your assumption, right? Do, test it. And a business model, it's testing with people, with potential customers, with potential experts in the space, with potential partners, and evolving that model. Okay, so pause for a cup of coffee or just to sit. I'm now going to walk through the 3x5 model, and then I'm going to switch to a poll everywhere. I'm going to ask you all three questions. And then once we've done that, I'm going to pause and we can bring back up the model. We can talk about the specifics. Okay. So if you've got a question as we're doing this, just drop it in the chat and know that we will get to it in a moment. Okay. So as you think about your model, right, what you're looking at, and I'm fairly confident all of you have seen, a spreadsheet like this before. So I apologize for a moment of being pedantic, but across the top, right, the columns are years. Year one, the upcoming year, all the way to year five. And I often get the question, why 5 years? There's plenty of answers associated with it because one's not enough and 10's too much, right? There's not a really good answer, but it is fairly standard that when you're looking at these models, 5 years is the time horizon, especially if you're looking at venture funding that people are used to and expect to see. Okay, so the top half, the first 4 rows, are revenues, right? And things associated with it. And so the revenues, the top line, then in this case, we have some assumptions we'll get to in a moment. And then the next 4 lines are expenses, right? So how much it costs each year to deliver our company, right? And then the bottom is the net income, which is generally just how much you brought in revenue minus the expenses. We're not getting into accounting. We're not going to talk about, cash flow versus, different accounting principles. This is a very simple model to start. And I have seen early on some very sophisticated models with deferred income and R&D credits and all those kinds of things. And you may need to get there. I would urge you in your first few models, acknowledge that's something you have to get to, but it's difficult to iterate once you start going down that path. Okay, so in our example here, and this is a hypothetical example, this is not a real business, right? What are the 3 most impactful revenue factors? We've said in this model, it's the number of customers, how many units we're selling to that customer, and what price we are charging per unit, right? Pretty simple things. And again, we're keeping this example very, very simple. So those are the 3 things we think are most important, the revenue elements that are going to most important to driving our assumptions in this model. And then on the cost side, we've decided that the 3 most important things is headcount, how many people we have in the company, because this is a company that needs to relatively quickly get a fair number of people to be able to deliver the product. Our cost of goods sold, because we're selling a thing, right? So how much does it cost to deliver each one of our things, right? And then something called customer acquisition cost, or CAC. How much does it cost us in marketing spend to get a new customer, right? That can come in myriad ways, right? It could be a business where you go to 4 conventions a year and do a booth and spend all that money and get customers that way. Or it could be a mobile business where you're spending X dollars in ads to get new customers, right? It doesn't, in this case, suppose how you're spending the money. Just when you divide up all the marketing money you've spent by the number of new customers you've gotten, this is what it costs to get each new customer. And for many businesses, a really important metric, because if it costs more to get a new customer than the lifetime value of that customer, Houston, we have a problem, right? Okay, so let's add one more thing, and then I'm gonna move to our poll. So our last thing here is how things change over 5 years, right? And again, you're early on in your idea. It's a perfectly reasonable thing to say, I have no earthly idea, right? But part of your job is to start building assumptions of what's going to happen and testing those over time, right? And I joke, we've seen models that come in that have like how many paper clips the company's going to use in year 5. That's not what we're talking about, right? We're looking at broad trends. And what's most important to be able to engage with a potential partner or an expert, and ultimately with finance folks, is what's the story you're telling here? What's your rationale? What's your logic? The logic is much more important than the specific numbers. So one simple example here, right? We've got customers going from 500 in year 1 all the way to 5,000 in year 5, and sort of a progression of really growing rapidly between year 2 and year 3. I should be able to tell a story of why I believe that is happening, right? And then second, the units per customer, right? And it's interesting because as we get more customers, I'm assuming that we're going to get more units per customer, right? And maybe my story here is early on, nobody knows who we are, right? And they're going to only buy a little bit and try us. But as we get more of a reputation, as our product gets into the field, as we have a positive, beneficial sort of word of mouth, people are going to start buying more at a time. They're going to be less reluctant and more leaning in, right? That may or may not be true, right? But you need logic at least to be able to explain that. And then finally, this one is counterintuitive to some, right? So our price per unit that we're charging the marketplace in year 1 is 25. And by year 3, it's down to 16, right? Why might that be? Well, this is a good place for you to apply your logic and say, well, early on, we've got early adopters, right? And they're going to be less price sensitive. But as we move into the market and we try to expand the number of people, we're going to start moving to the middle of the market, right? Where there will be more price sensitivity. In addition, if we're successful, what's going to happen? Well, we're in a capitalist society. Competitors are going to come in, right? Which is also going to put downward pressure. So a lot of times I see these models, and I'm not giving you advice how to build your model because I don't your specific business, but I see a lot of models where pricing in year one just, by year five is 2 or 3x, right? And so I put this example in purposely to say it may not happen that way. It might, but chances are pretty good. Actually, there's going to be significant downward price pressure on any product. And again, your mileage will vary, so you've got to think about your specific case. Okay, so now I'm going to shift and stop sharing. And I am going to share a very simple poll. Super duper mega. Nope, hold on. I'm going to stop that. Really doesn't like sharing the poll, Nikki. There we go. And so actually, let me do this differently. Sorry. Let me give you the opportunity because many of you have not used Poll Everywhere before. So this slide, if you scan me, if you scan that QR, that'll take you directly to the poll. I'll leave it up for a moment. You'll be able to scan in the poll as well. But if you scan that, it'll open up your poll, or you can just, with your browser, go to pollev.com and enter in Joe D. That would be me. And if you happen to have the Poll Everywhere on your device, you just open the mobile app and type in Joe D. All right, now we're going to share the actual poll. I'm going to activate it. And we're going to present. Okay, so you're not going to be tagged here, so you're fully anonymous, right? But what is a likely key driver of your revenue? So remember, I went through that example with three, right? You can offer more than one. You can answer this multiple times. That'd be great. But you think about what's a big driver of your revenue? Service and memberships. What's a key driver? Advertising, multi-day events and camps, subscriptions. Price. Yep. Number of users and how often they are using the app. Give you guys a couple more moments. Affiliate commission. How many customers convert from trial subscription? Recommendations, right? To think about part of what you're doing here, right? As you think about these assumptions, and you can keep adding. So if you've already put one, there's no limit. You can part of what you're doing, and again, I'm oversimplifying, but purposely, is your assumptions have to drive math at the end of the day, right? So as you think about a key driver of your revenue, you want that key driver to be able to contribute to your analysis of your business model. So remember back to the example of the customer acquisition cost, right? And that's a key driver of that business because we need new customers. And early on, it's going to be really expensive to get them. And we didn't talk about it. I can go back to that model in a moment. But the assumption in that model is over time, we get more and more efficient. We have to spend less to get each individual customer. So as you think about this key driver, it ultimately has to have implications for your business model to be a key driver, right? And you have to use it to be able to factor in the math because at the end of the day, your business model is going to have math. It's going to have numbers around revenue, how much you're bringing in, and numbers around costs and how much it's going to cost to deliver that. Okay. All right. So let's go to our second question. What is a likely key driver of your cost structure, right? So again, you can answer this many times as you want. Think about the math of this, right? So a simple example, For this, it's what's my cost of goods sold? How much is it going to cost me to make one of those? So if that's a big uncertainty and a key driver, I better spend a lot of time and effort making sure I get that right, right? If it's not a key driver, like, how many paper clips I need to have early on, I shouldn't be spending any time thinking about that. Part of why we do the 3x5 model is to help you focus your energy on the things that are most important, the uncertainties that are going to drive your model. The technology, renting a building, man hours, right? And again, be as specific as you can. This is great. And we'll give you a few moments for this. We're not in a big hurry, right, Nikki? We're okay on time. What are we on time? Oh, we're great on time. Liability insurance, $3.50 per customer through social media and branding influencers and newsfeed advertising, marketing. Driving technology to consumer scale. Give you all another moment or two. What's a likely, and at this point, you may not know, that's fine, but right, part of this iterate and collaborate is to be thinking about these factors, right? And you may start with 20 to get to your three, or you may start with three and find out, as I start collaborating with people that know the space, I said, I wouldn't really worry about that. You know what you're missing? You're missing X, right? So again, think about this activity as you want to start that process of thinking and doing. Economy, database storage, core staff, right? Because you think about this, right? These are the things as you identify them, you're going to put your time and effort into, or your member of your team that's thinking about this on the cost side to do this, right? And so these should be, it's like a to-do list in some ways, right? These should be at the top of your to-do list. Okay, so keeping us moving, one final question. What is a key factor that's likely to change over time, right? Some of your things may not, right? It may be fairly steady state. I know to start, I need 5 people, and I can do 5 widgets or 5 billion widgets with those 5 people. Obviously, a terrible example, right? But as you think about the key factors, either on the revenue side or on the cost side, what's likely to change over 5 years' time? Because that again is an indication of something you should be putting time and energy in thinking about that arc to be able to, one, inform your model, but two, to be able to tell your story of what's going to happen and have people react to it. And they can say, I've seen a similar business before, and you're not going to quadruple in the first year. This takes 2 cycles. Great example while you're typing your responses, and I'll review them. The K-12 ed space, right? Ed tech space, right? A lot of folks say, hey, I'm going to get my first sale in year 1, and then by year 10, I'm going to, by year 2, I'm going to have, 10 times that, right? Ed tech takes a long time. There's a long selling cycle, happens typically at conventions. School districts take a long time to make decisions, replacing existing technologies, right? So that's the thing that's likely to change. That shows you've got insights into that particular marketplace. Okay, so let's see. We've got demand, technology, production, desire for people to want my product, AI competition, love it. Customer retention, branding, and loyalty, right? Everyday regular customers, right? So as you think about this, this is an area as you prioritize change that you're going to want to spend time and energy thinking about. Competition, no question. And again, I often get no one's ever thought of anything like this before. No one's serving this, this unmet need. Number one, nope. Number two, nope. And number three, assume you're going to be successful. And that's going to bring in competitors. So how are you going to deal with that? Young customers to educate. Love it. This is great. Okay, so I am going to stop sharing. And I promised at this point I would stop and address any questions you all may have. So you can have them in the chat, or you are welcome to just, there's a small enough number of us here, you can just unmute and talk, or whatever works for you. Are there any questions in chat, Ms. Peterson?
There are none right now,
Okay.
but we've got plenty of time and space for them.
Okay. Any
I just
question?
have a question,
Yeah.
in this AI world, everything is changing almost every day. So, is it better not to plan anything, or because it's very difficult to anticipate what would happen maybe in a month's time,
Mhm.
right? So, I mean, I'm not sure what to, go about, doing, because I think one way I think all planning is, just waste of time, and the other way I think we should have planning, but what kind of planning, right? Yeah, I need your thoughts about that.
Yeah, sure. We all have our sort of opinions on this, but I think I can state unequivocally as you're thinking about building a venture, anyone you engage with, whether it's a possible co-founder, somebody who works for you, a potential customer, a partner, and certainly somebody who might want to invest in you, is going to expect you to have done some solid thinking, and evolved your plan to the point where you can lay out your vision, but then you've got a way of validating the business model. I appreciate your comment. It does feel like, the world changes 20% every week. I've got gray in my beard. I'm old. I've seen a ton of changes. When I was in business school back in the 80s, October 1987, the world completely changed, right? The market took a dive. We thought that's the end of capital market, blah, 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 right? There have been lots of upheavals. I know this one, for those of you in the, impacted by artificial intelligence and feel like, boy, that's just accelerating and it's changing how we think about business and customers. Absolutely, those things are all true. But the one thing that's constant about change is things are constantly changing. I think it is extraordinarily important to build a plan and a business model. But I also think it's important to be flexible. Part of what we teach is a growth mindset, right? And several of you have heard my joy of the Mike Tyson quote, no plan survives the first punch to the face. And Mike Tyson, a famous boxer, right? You got this great plan, and then you go out and you talk to a customer, and they're like, yeah, that's not what I want. Or you go to a financier, and they go, yeah, that model doesn't work for me, right? You got to have a plan for folks to be able to react to, and for you to get into that think, do cycle and evolve it. And it's extraordinarily important. And I would argue it's probably most important for you because it helps you start to make your vision real and articulate a way that either gives you more confidence that what you're pursuing could work, right? Or gives you some pause to say, I'm not sure I see how to do it, which either causes you to evolve it again, or sometimes to say, I've hit a cul-de-sac. I don't think there is a there. And it's better to learn that sooner rather than later, right? And without a business model and a plan that you've torture tested, you may have an idea that you feel the greatest thing in the world, right? And we talk about better to be specifically wrong than vaguely right. Lack of a plan, you can be vaguely right all day long and 15 times on Sunday, right? Versus a hard plan where someone goes, yeah, that's not going to work. Let me tell you why. It's better to have that specifically wrong to either evolve that plan or decide that what you're putting your energy into is just not going to work. But it's a very good question. And I appreciate the, feeling that we're in turbulent times, because we are for sure. I would just argue that I've seen about 40 turbulent times in my time on this earth.
Hi, Joe. I have a question.
Sure, fire away.
Yes, about the revenue models. I once heard that there were a few hundred different revenue models. I don't know if they were like adaptions on your list or not. But I was wondering if you have a source, for those other, ideas for revenue.
Yeah, so I'm going to share my screen again on that slide. That's a great question. Thank you for it. And this is the moment where Nikki gets nervous about me because I tend to be, what's the word we're looking for? What's the safe word, Nikki? Outspoken. That's the word. That's the safe word. Yes. A loose cannon might be the more appropriate one. This is pretty much it. I mean, there's hybrids of this, right? And I'm sure there's always some extreme edge case that's 5 sigma from the mean, whatever, right? This is pretty much it. This is, and we do hear this. I'm embracing your question because it's a really good question. We get this a lot. Well, I haven't figured out my revenue model yet. It's going to be a unique revenue model no one's ever seen before. You're either selling units, you're advertising fees, you're franchising, you've got some version of utility subscription transactions or licenses. I'm not going to say that's 100%, but pretty darn close, right? But our point really at your origin, right? is to be thinking about them in the simplest terms. You can always make it more complex. You can always make some sort of hybrid thing, right? There's lots of ways of doing this, but to start, strongly urge you to pick a clear and very understandable business model. I've certainly heard a bunch of pitches in my day that are, that I get through the first 5 minutes and I go, well, let me stop you for a moment. How are you going to make money? Well, it's kind of complicated. I'm like, it better not be. It better not be complicated how you're going to make money at this stage, right? It better not be. And so I hear you. These are the business models I know of, and some potential hybrid versions of this, right? And if you think about pick the top 25 companies you interact with on a regular basis, or you admire, or you hate, whatever it might be, they fall into one of these categories. But it is a really good question, and I appreciate it.
Okay, thanks, Joe.
Yeah, sure. See, I did that, Nikki, without sliding into things
You
that I
did
shouldn't have done.
great. That wasn't too bad at all.
Other questions? This is sort of the core thesis. The last bit I do want to talk about, but it's sort of a bonus. This sort of 3x5 model, which I am going to put back up again, and this core idea of understanding what your basic business model is, right? Is what you've got to focus on in validating. Sorry for the move, right? So you, at this stage, even if you're very early on, should be able to take a credible pass at this. And the numbers may feel nonsensical, right? That's fine. That's a great opportunity for you to say, here's my logic, torture test the logic, right? And maybe you go, I think it's subscription. And then you get some feedback and go, nobody does subscription in this space. The customer really wants to know that they paid for it once. I'm making that up, right? That's great to know. All right. So now I got to adjust the model, right? And don't be emotionally engaged, right? The better to be proven wrong than sort of vaguely right, specifically wrong instead of vaguely right. Embrace that, right? You're a growth machine. You're a learning machine. And so I know several of you on this call are scientists, right? It's the empirical method. What are you trying to test? What's your hypothesis? You test it and you either prove it out or you don't. And it's the knowledge that you gain from that process that moves you forward, not whether you were right or wrong. Obviously, we'd all rather be right and keep moving forward, right? But knowing that you were wrong helps you make an adjustment. So this is, of what we've been talking about today, this fundamental framework is the most important thing I want you to take away from it. And then, of course, always the Mike Tyson quote that you can plan all you want. And as soon as you get into the marketplace, as soon as you start torture testing it, you're going to find you were off by either 20% or 200%. Okay. So I'm going to talk about
just a quick question, John.
Yeah, of course. Go ahead.
Yeah, so if you go back to the model, how do I come up with these numbers, for the first 5 years, how something, very, very, I just want to be as close realistic, at that moment as possible. I know things can change, but
yeah, it's a great
approach that you can come up with, or it depends.
Yeah, absolutely. So typically you want to take, you want to have someone that you feel like you can partner with, that you can take an approach. If you feel not strong about understanding the numbers, who has some knowledge of the industry or the space or the customer, right? To get your first pass. The most important thing is to get that basic framework right, in my view, and those factors right. And then start torture testing it with people that know more about the space than you do. I've worked personally on 25 or 30 startups, right? And I'll build a basic model. And then, and I try to solicit some input from folks that I think, know more than I do about it, or have a particular insight, or have done some basic research, right? And then I go to, a friendly that knows something about the space and says, here's how I'm thinking about this. So what have I got right? What have I got wrong? And often I start with, what have I got wrong, right? Am I thinking about it the right way? And then as I'm thinking about it, are any of these things realistic, right? And some stuff just doesn't meet this smell test, right? It's like, I've got 5 customers in year 1, and by year 5, I have 500 million, right? I mean, you can start to get parameters that make sense pretty quickly. And then it's about, how do you make those adjustments in collaborating, iterating, that get you more confident? This is about, this may sound a little terrifying, but I've worked on projects that have had 150 iterations of their business model before they got funded. And I'm not saying you have to do 150, but that just gives you an example of, it's not like you do it 3 times and you've got, it's like a baking recipe. Yeah, first time the souffle fell, second time the souffle exploded, third time I got the souffle, I'm good to go. Just hit that recipe over and over again. And by the way, I have had a souffle explode. It's a good learning lesson on how to clean an oven. It's just not pretty. Anyway, the point being, expect that you're going to have to iterate. Expect you're going to get different points of view. In fact, the more diverse points of view you get, in some ways, the better. But at the end of the day, you want people who can give you insight that you don't have on your team, as advisors, as team members, as part of your kitchen cabinet. But it's a very reasonable question, and I think the most important thing I can tell you is, we talked about this in Making the Leap, right? Is about starting, right? So it's say, here's my question that I don't understand. Here's my hypothesis. Here's how I'm going to test that hypothesis. And here's the result, right? Once you start on that, that drives you to action, right? If it's all in your head and you're not getting that process, that think do process, you'll never progress. And look, nobody wants to like share a model with somebody who's a finance expert in that space, and they're going to go, "Oh my God, that's like ridiculous. Why did you think that was going to work that way? That didn't feel great," right? But it feels a lot greater than spending 6 months on it and having that conversation, right? Better to have that conversation the first week than, at the end of the first year. So part of this, and now I'm putting my professor hat on, is you got to put yourself out there a little bit and be willing to test things, and know that what you're going to put out not only is not going to be perfect, it's probably going to have a lot of flaws in the first many iterations. All right, so not a great answer in terms of like emotionally satisfied, but in my experience, it's a fair one.
Perfect. Thank you.
Yeah, of course. All right, so let me go back and talk a little bit about this. So what we've talked about so far, right, is this bottom-up model, right? And we think that's the first thing you should do, right? Think about the specific elements that are driving revenue and cost, right? And build that up, knowing it's going to be imperfect, knowing you're going to have to evolve it, knowing at some point you're going to have to add a lot more detail, right? But start, right? And then the second part of this that we strongly encourage you to do is then just like rational test it, right? So look at a top-down view, right? We've seen plenty of models. Somebody build the bottom up, and by year 4, they have 400,000 customers, and paying X amount, and they're doing $10 million in business, right? And they go, how big's the market today? How many users are actually doing something like this? And I was like, well, there's currently like 8,000. I'm like, so wait a minute, so you're going to drive the industry from 8,000 users to 408,000 users over this period of time? I'm not saying that's impossible, but that might want to give you some pause, right? So start looking at some top-down things that, by year X says you're generating this much revenue with these many customers, just as an example. And how's that compare to the market overall, right? And does it meet the test of reasonableness? The thing you want to avoid, right, is, and I'm sorry, we see it a lot, right, Nikki? As someone does, well, I think there are, 1 million people that want this, and it costs $1,000, right? So it's $1 billion business, and all I have to do is get 2% of that, and I've got a huge business, right? No, please, for the love of Mike, no, right? That might be a reasonable test when you do the whole thing and you say, at the end of year 5, I'm gonna have a $20 million business, and that represents 2% of the space, but I've built this bottoms up. That might be a reasonable test, right? Not in this business. If you got 2% of this business, there would have been Ragnarok or something like it, right? But the top down should not be your driver to say it's $1 billion market. I'm going to get 2%. I'm going to have this $20 million business, right? That's not logic, right? That might be a way to test your bottoms up assumption, but please don't go, the TAM is this, the SAM is this, and my share of it's that, and that's the business I'm going to get. Okay, so just a couple more things, and then we'll take questions again. So as you're building confidence, right, the more customer feedback and expert feedback you have, the better, right? This idea of the market, right? Understand what the market is, so you're not creating this unrealistic set of projections, that you're thinking about the market in a way that you can grow appropriately. You have some level of a prototype, which is really helpful to test, even if it's a conceptual prototype, right? Ideally, then progressively a working prototype so customers can give you feedback. And then, of course, ultimately a paying customer, right? As you think about building confidence in your numbers, as you move down that, right, from customer feedback to a really clear understanding of the model to a prototype people can react to, hey, I actually sold one of those, right? It's not enough to say victory parade time, right? But it's enough for you to be thinking about it. Okay. And so I'm going to talk about two more things, and we'll take any final questions. So some of you have been in the academies, you've seen this chart before, right? And we talk about these sort of stages of typical venture funding, right? And some of you may be thinking about a thing that's bootstrapped. You're not going to need any venture funding. You can fund it through, early sales, and you don't ever need to raise money, right? This is for, for entities that might need to raise money, right? So as you think about this sort of going from left to right, and we're our university, so often things start with basic science and research grants, and then SBIRs, moving to going to family and friends and angel investors, to venture capital, to private equity, to some sort of IPM or merger or acquisition, right? In terms of funding, and then on the bottom we sort of go through what is the stages and of the actual venture, from basic research through working prototypes to actual product to ultimately a business that's growing in revenue. So as we think about this from a venture standpoint, right? We know, and again, those of you who've been to the academy, right? There's a lot of folks in the basic research level, whether it's in a lab or in your dorm room or wherever, thinking about this, right? But as you start moving to applied research and proof of concepts, there is this huge cliff of commitment. I just don't buy it, or there's so much uncertainty, I can't take away from my day job or whatever to do this, right? The reason I'm bringing this chart up is this idea of net cash flow, right? And so as you think about most ventures, right? And very early on, I talked about when will you make money, right? You might get a little bit of cash flow from research or grants or whatnot early on, but as you move towards the expensive part of actually building your business, doing a proof of concept, right? Going out to the marketplace and actually, building the business and hiring staff. Typically, this blue line, your net cash flow, goes negative, right? Assuming that yellow line in the middle is the gray line in the middle is sort of neutral, until you start moving to to real scale. And so the thing you need to be concerned about is this valley of death, right? This sort of max cumulative negative cash flow. And the basic idea, the only thing I want you to take away from this is most ventures end up needing money to come in. Some money could come in as equity, some could come government grants. Theoretically, some come through loans, although that is becoming more and more difficult for early stage companies in particular, right? But be thinking about this idea, right? And so why does it matter, right? If you look something like that blue curve, right? If you need to spend money before you can make money, then you're going to need to raise money from other people. And those other people could be the government, right? In some cases, it could be individual investors and the like, right? So this is another reason why you need to know how much money you're going to need to get there, right? What does your valley of death look like, right? When are you going to be able to make money? And then be able to convince people that your framework, your viable business model, is worth them making their investment. And remember, I said, we're not going to talk about this in great depth. This is a whole area of study, and that's not the thing the Institute focuses on, although we certainly can talk about it, right? Because you think about the end game for an investor, right? So if you come to me and said, hey, I want you to invest in my company, right? You need to be able to convince them, simply put, that there's significant upside to tomorrow, right? And that there's either going to be some sort of an exit, an acquisition, an IPO, or this is going to be a nice sustainable business that's going to throw off cash and dividends or whatever it might be. I know that sounds incredibly simplistic and a little cold, but at the end of the day, outside of philanthropy, where people put money in, from a nonprofit standpoint to go after, a particular mission, and even then, you've got to convince them that the money is worth, that you're building a viable entity, right? If you're going to go after investor money, right, you have to be able to convince them there's an upside, there's a pot of gold at the end of the rainbow, right, and that there's a mechanism for that to take place. And again, there's a whole conversation or more about this. But because this has come up a number of times, I wanted to touch on it just for a moment. I'm still okay on time. I got a couple minutes. And then we're not going to talk about this at all, other than to say in several of the conversations we talk about dilution, right? And people say, yeah, well, I want to raise money, but I'm then going to own less of the company. Like that's how it works, right? And how you negotiate how much less and whatnot, that's a whole thing, right? And I would argue that having the right partners, having a good legal partner early on, having somebody who understands this is important if you're trying to build a venture-backed company. The reason I talk about this is people either get obsessed with it and spend way too much time thinking about what their equity looks like, or completely ignore it until it's too late. I offer a third path, which is to be cognizant that, and we're not going to get into specific numbers, that typically early on you own a lot of the company, right? But as you bring money in, you're going to get diluted. Your ownership position is going to go down because those people that are investing, that are looking for that pot of gold at the end of the rainbow, need to own a bunch of the company to know that their risky investment early on, if you succeed, is going to make them a substantial return. We're not going to get into CAPM and risk reward returns or things like that in this conversation. So this is just not meant as a primer, other than to say this is something you'll need to think about. Not obsessed, not ignore. You should think about finding your company if you're going to raise money and bring in outside money to move the company forward. Okay, so last two slides, and we'll have a couple minutes at the end, right? So as you think about your business plan, right, starts with you have a real problem that you're trying to solve, and there's real pain there, right? And that it's enough of a bleeding from the neck problem, and enough people have it that it's worth pursuing, right? And that what you're pursuing, right, is a viable way to address that pain. And I use the word pain here specifically, right? And so that's a precursor to the business model. If none of that's true, then you can have all the numbers on a spreadsheet you want, right? And then you need to think about what's it going to take to get you into the market? How are you going to grow over time? How's your cost going to grow? And that ultimately, if you're looking for venture investment, your potential profits are worth their time. And then so in summary, sort of this is the last of our workshops till we get to the specific pitch. Know your product, your market opportunity better than anyone else is simple and simplistic advice, but it's good advice, right? Make sure you understand, you know your risks, what your potential competition is. Build your business model from the bottoms up, right? Don't do the 2% of the TAM and I'm good to go, right? Know your customer, right? That's at the core. And you remember when we talked about market validation, right? The most important thing you need to understand is your customer. Everything comes from that. It's not sufficient, but it is necessary, right? Know your economics. So what is driving your revenue? What's driving your costs, right? And then demonstrate, maybe not early on, but there is going to come a time when the resources coming in are going to exceed the resources you need to deliver, right? And then, if you're taking an investment, you need to be able to make the case that you're a good candidate to exit or have a nice profitable business. And again, a light touch on this. This is not the focus of what we do, but even in the big bang, it's likely, particularly as you get to the later rounds, where you get to the, to the in-person rounds, you're going to get this question, right, Nikki? You're going to get the panel going. So how is this gonna make money, and how is it going to ultimately be worth an investment? Okay, so I am going to stop sharing. There we go. All right. So we've got a couple minutes for any wrap-up questions. Always glad to take them on any topic.
I see one in the chat from Miriam. Out of curiosity, how does a business model look for a consulting firm?
Well, it depends on the consulting firm. If you're McKinsey, it looks really good. Although, to a point made earlier, AI is disrupting that business as well. So I know a fair bit about this. I'll give you the 2-minute answer. The 90-second answer is a much longer answer. So it's a services business, right? And at least in theory, consulting is always driven by, on the revenue side, how many clients do you have, paying how much per engagement, and that's typically driven on an hours basis. So what can you charge for an hour of consulting time, right? And the flip side, what do you have to pay those consultants, on an hourly basis? And when I was at Booz Allen, the model was 5.6 to 1. So whatever the base pay of the consultant where they were being billed out at 5.6 times that. That model is not sustainable anymore. But the idea is that you've got some multiple of the cost of your employee who's doing the consulting, and that covers the cost of them, it covers the overhead associated with them, and a profit margin. So it's a lot like a law firm or other services businesses were driven by number of customers, number of clients. What are they paying for engagement? How many hours you need to deliver for that engagement? What do you have to pay your staff for that? And then a really important factor, most consulting businesses are driven by, what is your allocation of your usability rate, right? Your billable. And, typically if you're billing less than 60% of your hours, you're in trouble in a consulting firm. And if you're building more than 80% of your hours, then you're in really good shape if you price the market right. And if you're in that 60-80%, you're in the sort of, but that depends on what's your billing rate, right? If you're billing $1 million an hour, 1 hour a year, you're probably doing okay, right? If you're building $5 an hour, there's probably not enough hours in the year to actually make it work. But typically you think about utilization rates, and this sort of 70-75% is a good consulting business. But it's driven by what you get to pay your people on an hourly basis, what you can bill them on an hourly basis. So simplistic answer. There are a lot of models out there that you can look at it, but it's a human services driven variable cost business. It's all about utilization.
Thank you.
Anything else? We're just about at time, so that's actually kind of perfect for a wrap up if there's no other questions.
Great. Well, so what I'll do, Nikki, is I will just one more moment go back and share our reminder here that we started with. Oops, a minute now. All right, stop sharing. Don't know why it's got two versions of it. Okay, we'll try that again. All right. So just as a reminder, we have our upcoming workshop in April for those of you that are in the Big Bang. And actually, you don't have to be in the Big Bang to go to that workshop, right, Nikki? So
That's
you're more than
correct.
welcome to. Your deadline, March 3rd for the Big Bang, please enter. It's going to be a great competition this year. Don't wait to the end. And then if you're interested in a more in-depth conversation, you're not able to do a 4-day academy in the fall, and you want a really fun half-day experience, you're more than welcome to join us at the Entrepreneurship Academy Foundations in a couple of weeks. And you can get more info, sign up to be on our mailing list by scanning the QR code. And thank you all for your time.
All right. Good to see you all. Take care.
Happy Thursday, everybody.
Thank you.